Good evening everyone, this is Sam. For today's video, we're going to be doing a bit of a class on finance. My goal today is going to be to explain to you guys the portfolio theory from Markowitz through the GW2 video game.
Weekend millionaires, just trying to be cool. Yeah, one day we'll be there, till Monday comes again. We're weekend millionaires.
The portfolio theory is a very simple explanation as to how building a portfolio with maximum return and minimum risk works. To you, player who is in GW2 economy, trying to fight and get the good investments for your own, this theory might help you in deciding whether or not to invest into a given item. First of all, let's do a little bit of history. Markowitz made that theory back in 1952 and eventually got a Nobel Prize for it. The theory is very simple. It allows risk-averse investors to optimize the expected return in a given market by taking into account the risk inherent to it. Simply put, it means that you, a Guild Wars 2 player, you do not want to buy items that have a risk of going down, and as such, you will build your portfolio in a way that you will minimize your own risk. This means that you need to have a global picture of your portfolio and not count asset by asset what is going to happen. You need, at some point, to weigh down the entirety of your portfolio, asset by asset, in order to determine what is your expected return and the inherent risk to it. This can be done very simply by doing the following formula. Asset weight times asset expected return, and you add all of these up for each asset. This might give you a first idea of the expected return of the entirety of your portfolio. Of course, the expected return is not necessarily an information that you can determine just by looking at an item. The best way for you to proceed about this one is to look at the history of the items trading on GW2 BLTC or any other website that you deem worthy of your interest. Then you get into the second part of the theory, which is rather interesting for us. It is what we call the correlation. Each asset does not work completely independently from another. It also means that you have the possibility to build a portfolio of assets that have completely opposite correlation, which is to say -1, in order to always be protected against risk. A very good example in real life would be, since it is the summer, I am going to be investing half of my money into a company that makes umbrella and the other half into a company that makes sunglasses. This way, whichever weather is going to be occurring during the summer, I am going to be sure that I will get some of my money back. All in all, with 50% weight in each, and an expected return of 100% of one and -100% on the other, I would break even. That is, of course, expecting that there is only one possible outcome for each step. By putting this onto a GW2 perspective, I could take, for example, a balance patch. For each balance patch, we see either power bills or condi bills on the rise, which means that if I, as an investor, would put half of my money onto buying materials or recipes to make power food, and if I put the other half of my money into items or recipes to make condi food, both having to be, of course, best slot and sought after, then I will have a perfect portfolio with zero inherent risk. Indeed, whichever outcome happens after the balance patch, I will be getting some money back. Now, this theory, of course, has some flaws. It assumes that within a simple market, every investor will make the same decision with the same set of information. That is to say, if all the investors at the same time are looking at the patch notes, normally all of them would take similar decisions given a specific item. This, of course, is not always the case within the GW2 economy. A lot of people can misinterpret patch notes or decide that they actually want to get rid of an item as it is spiking, which leads to a saturation of the market before the wave has fully taken off. Necessarily, it also means that you need to pay attention to the right moment to unload or not your assets. In all honesty, I think that this theory is a very good starting point in order to build a portfolio that is not entirely risky. That is to say, if you take a few assets that have a potential to be correlated in opposite to another, you will be sure to protect yourself against some of the risk. Finally, to conclude with this video, the theory by Mr. Markowitz says that investors are always going to try to go for the same portfolio, one which is completely optimized for the highest possible return with the minimum possible risk. Within the GW2 economy, there are a few ways to achieve this without necessarily exposing yourself to risk. A good way to do this within GW2 is to buy items that are either oversupplied or about to leave the game, or finally, items that are no longer available. A good example for this one is the fused skins. Each time they were released again, the fused skins regained some of their original value due to the fact that they are heavily sought after, and the aggravated scarcity makes them even more expensive. You could also look at some items that were dirt cheap, for example the tier 6 leather, and which then took off when the right sync was introduced for them. Investing in tier 6 leather was risk-free because it was at vendor value. I hope that this gives you a better idea on how to conduct your investments. If you have any questions about this theory, you're free to ask me within the YouTube comment section. And if you're a Patreon, you can ask me to have a look at your portfolio and tell you whether or not I think it has been optimized. If you have any other further inquiries, you're more than welcome to join our Discord server and ask me directly. Now, I wish every single one of you a happy trading and to get rich.